All right, good afternoon, everybody. This is Phil Resch here. Just coming at you today with another sales idea because really, when it boils down to it, it's not only the stories or the products that we sell, it's really the stories that we tell. And so today, I'm here to bring you the probably the best story that I've got, or one of the best stories to offer an opportunity for you to solicit high net worth sales. And so, anytime you're in this industry, having the opportunity to talk to high net worth people gives you the ability to make large sales, but there's a lot of work that goes into it. So, what I would say is if you've never done it, don't go at it alone. That's what people like myself are here for. The value proposition. I've been in the industry now 16 years. I've done high net worth estate cases with financial advisors, with CPAs, independent agents. And so the idea when you talk to clientele is that they might, especially larger net worth cases, they usually have a counsel with them already. So don't be afraid when someone says that they need to talk to their financial advisor. I would encourage it because the financial advisor doesn't want to do stuff like what we do. I worked with them for about 10 years, and I know for a fact they don't like talking about life insurance because it's not in their wheelhouse for the most part. There are some who do. But nonetheless, this is a very important topic. So when we think about the estate planning arena, we're going to talk today about who needs estate planning, some of the current tax law. I'm going to talk about rumors and hearsay that we're hearing in Washington as well, and then some strategies to protect the estate. And then once again, for those who are watching this on YouTube, you will not see the actual whiteboard presentation that I will be doing off script, so to speak, or off the recording. So, those who are actually attending live will get that extra bonus. So let's just start off talking about who actually needs estate planning. So estate planning is a broad topic or a broad subject. So everyone technically needs some form of estate planning. So when you think about it, when we talk about just basic general estate planning, we're talking about wills and trusts, naming guardians in case something happens, something unexpected happens. There is someone to take care of your loved ones in the unexpected event of you passing away. So all of this is, your basics. A typical, uh, lawyer would probably price wills and living trusts combined for, two spouses at about anywhere from $1,000 to $2,000. Uh, we have software and opportunities that we can provide to give that to our clients from anywhere to 300 to $600. And if you're not familiar with that, feel free to reach out to me after, and I can help you out with that solution too. But the big one today is we talk about advanced estate planning, and we need to understand some of the rules of the road regarding gifting limits, lifetime gift exemptions, legacy planning, and trust design to really tackle some of these larger problems. And so before I get into all of this, I'll actually back up for 1 second so we don't get all mangled with the busyness of the slide. I'm going to talk about some rumors and hearsay, what's going on in the industry. So again, this isn't gospel, just things that people have been talking about from changes inside, the White House kind of conversations. So as we all know, Biden is president, and with that comes the Democratic Party. Democratic Party typically focuses more on the blue collar people, middle class, lower income, things like that. Everyone who has a shot to get to that upper class, they want to focus on that, which is perfectly fine. But what they have to do is they have to figure out ways where they can provide taxing to, say, someone who has made a larger estate so they can help with the people who aren't quite at that upper level, so they don't get taxed incredibly well. Someone who has, made a lot of money will have to foot the bill, so to speak, for higher taxes, unfortunately. And so when we think about that, some of the things that more affluent people have, stock portfolios, real estate, things along those lines. And so again, the rumors in here say this isn't gospel, but say for example's sake, I were to pass away and my house is fully paid off. But I bought the house for say $100,000. It appreciated to, let's say, $800,000. Well, at the time of my passing, my property has what you call a step up in basis. Therefore, it'll come up to 800,000 when I pass it on to the next generation, and I don't have to pay any taxes for that. The thought is, or looking at eliminating that step up in basis is on the table because they want to find different ways where they can gain revenue. And that's a very easy one to pick at because the cost basis wouldn't travel. Therefore, that would be a $700,000 gain that my next generation would have to pay. Same thing with stocks. Stocks are very similar. Stocks, you buy, let's say you bought Apple stock in the 80s. It's a first $1 trillion company. It split several times. The stock split. But think of the fact that if you stuck with that stock from the beginning and it appreciated and continued to appreciate, the cost basis in which you'd have to pay off of that asset as well. So there are conversations about that, but that's all rumors and hearsay. Now talking more about what is coming down the pike to understand how to have conversations about estate planning, we have to understand some of the lingo, if you will. The first one and the big one is a lifetime gift exemption, LTGE for short, or I'm a simple man. I like to call it very simple things. I call it a death coupon. So how it works is that this provides protection against you owing Uncle Sam money if your estate is above currently 12.92 million per person. So in perspective, if I, Phil Resch, was a single gentleman and my estate was less than 12.92 million, I don't owe the government any money for federal estate taxes, which is currently at 40%. As you can see, from last year to this year, it did rise from 12.06 to 12.92. It will rise again next year. Now, I have a spouse, so if I were to pass away, married couples have what's called an unlimited marital gift. So my death coupon of 12.92 is now exchanged from me over to my wife. So my wife has ultimately protection. I'll use simple numbers, $26 million against our estate that when we both pass, the government doesn't shore up that first death, they shore up that last death for an estate tax. And they would basically look at our combined estate and say, okay, are the Reshes higher than 26 million? If so, that excess or surplus will get taxed at the 40% rule. Here's where the concern comes in. So right now, there's a shelf life on these rules. In 2025, the Trump tax rules will end, and that will enforce a reduction of the lifetime gift exemption or this death coupon that people have. And you're looking at 3 million. I've heard 6 million. I've heard 5 million a person. So we don't know where that scale is going to be, but you're looking at, if you have a couple, 6 million to 12 million for that couple. Now, the crazy thing, when we look at the example here, say you have a $50 million client, and currently they would be saving themselves or against 25.84 million in taxes using their death coupons at death. and exposed to 24 million in taxes. 40% of that is about $10 million, 9.7. After the changes, they're now exposed to more, 38 million in this example. Multiply that by 40%. They've increased their taxation by $5 million, over $5 million in this example. And with a timeline of roughly about 9 months to pay off the government for your estate bill, you have very limited options. So let's think about this. We have someone who's real estate rich and moderate for cash. Now all of a sudden they both pass away, husband, wife, and now they have a huge tax bill. The kids now have to find a way to pay for that in a short period of time. What does that lead to? Potential short sales of the property, and some concerns, a lot of heavy things to have conversations with your loved ones about. So when we think about this, the cool thing about this rule, the lifetime gift exemption, is you can use it while you pass or while alive. So our strategy here is we don't let the tax tail wag the dog. We want to be proactive, not reactive. And that's why we're going to talk about what we can do to leverage these type of assets for those clients who need it. Now, keep in mind, this is at a federal level. We also can't forget about state estate taxes and inheritance taxes. So there are, I think it's 12 states that have some form of taxation on top of the federal estate tax. So what I would say is you don't want to live in New England or die there at least. Pac Northwest or right around the Great Lakes. Because as you can see here, there's different types of taxation that will occur depending on your location. And so when we look at this, I really don't want to die in Maryland because they have federal, state, and inheritance tax. That's why you see its little stripes there for Maryland. But when you look at this, state means, you know, your assets are in that state, so you're going to get taxed on those assets. Inheritance tax is an interesting one. So say, for example's sake, I'm here living in Tennessee and my parents live in Pennsylvania. Well, if they die, then I have to pay the inheritance taxes for Pennsylvania because that's where their assets were. But if I'm living in Pennsylvania and my parents live in Tennessee, I don't have to pay inheritance tax because their assets were in Tennessee. So understanding and knowing based on where your clients are will also dictate what type of coverage or protection they need too. And so when we think about that, we think about estate planning. What can we do? There are trust designs and opportunities for people to utilize things like irrevocable trusts that give us federal estate tax proof, state inheritance, probate proof, creditor proof. And we can even show you how to control these assets from beyond the grave. So it's a very unique thing. And how can we utilize this lifetime gift exemption while alive before the ball drops on changing it to those lower numbers? Now, I'll show you an example here. Let's say, for example's sake, you got a 46-year-old male making a lot of money, and we want to utilize this gift exemption up front. We're going to reposition the assets, and we're looking at $1 million a year for 10 years. Now, if you'll see highlighted, they've paid a total of $10 million. We look at the far right-hand column at a 5.74% rate of return, and the client is pretty much whole by year 10. You're off by about $400,000, but you start out with an initial $50 million. And by the time they get to age of mortality, 85, 86, you're up to a total of $91.5 million and $48 million in cash. So once again, the idea here is how can we utilize estate taxes today to leverage and protect our clients tomorrow? This is the type of client that has already made enough to heat their grandkids' pools. And so when we talk to them, it's not about what type of accumulation and cash you can build, but what type of estate and assets you can protect on the back end. And so what I ask is, when you think about planning, failing to plan is a plan. It's just you're planning to fail. So when we think about it, the time is now to react to something like this. But not a lot of us want to do that because a lot of the people we talk to are still in that asset growing mode, even though they're worth 20 million, 30 million, $40 million, and they don't want to think about something like this. And so what I'll say is, now I'm going to share with you the opportunity on how I was able to close a $108 million case, but I'm going to take it off the recording because I want to reward those who are here versus those who are just watching this on YouTube. So sorry, YouTubers. We can always talk again. Just give me a holler.